Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Robb Fahrion. He's the CEO and founder of Flying V, our digital marketing partner. Robb, how was your week?
Weekend was great. Ready to be back in the saddle and get going. Obviously, crazy time just in general, right? With the news about President Biden stepping down, implications of that, but just crazy world we live in. We'll cover the economic side of it. But yeah, excited to chat with you today as well. How about you, Gary?
Doing all right. Just out of curiosity, you were saying before about being back in the saddle. That reminds me, you may have a horse racing story from the weekend.
Yeah, it was I think they call it a YOLO bet. And last race of the day, we were at the Del Mar racetrack opening day, and put a $20 bet on a 35 to 1 horse last race of the day. And just safe to say, we obviously ended up on a high note and a nice little payout on that win. The rest of the day was just ups and downs, but I think I might have cracked the code there towards the end. So next time we'll be looking to do bigger and better.
Outstanding. Congratulations.
Thank you. Thank you. Today, Gary, episode of the Five Things. This is the rate cut expectations, our 100% issue. Really curious what you have to say about that. I know we've been tracking what's going to happen with September and whether the Fed will be cutting rates. And we've got some strong percentages that are rolling out there in terms of a lot of people that seem to be quite certain about what might happen. We'll jump into that. We're looking at jobless claims coming in high. The Magnificent Seven's awful, terrible week. So definitely a different tune than what we've been talking about in months past. China and their liquidity in regards to banking sector, government spending, treasury auctions. We got a lot coming at you in this week's version. Should we get into it, Gary?
Let's go.
Alrighty. Thing number one, strong retail sales and possible rate cuts.
All right. So, Rob, the chart that we have here actually came from Michael Shedlock, who is the coolest economist I know. He goes by Mish. Right? We have the only economist with a mononym. He runs the fantastic Mish Talk blog. I highly recommend it for everyone, mishtalk.com. He is also a member of the Deep Knowledge Investing Board of Advisors. He has put out a chart pointing out the very, very close correlation, almost perfect correlation between final retail sales and expectations for GDP, the GDP now forecast. We've talked about that before. And if you think about it, it makes a lot of sense. When people are spending money, the economy is good. When people are spending less money, you're going to have lower sales, lower GDP growth. So what we had here was real final sales improving, climbing from 1.3% to 1.7%. So a pretty decent number. And because of that, the nowcast, which is the expectation for the future GDP report, rose from 2% to 2.5%. We've had a lot of debates, Rob, on this channel about whether the economy is in good shape or bad shape, whether we're going to see GDP growth or not. A 2.5% number, if they're right, and they do change these expectations pretty frequently, but a 2.5% number would be considered good.
Gary, you've mentioned that this economic strength and the takeaway might complicate the case for the Fed in regards to a rate cut. The market is currently talking about a 98.1% probability of a rate cut in September. You think that still is not necessarily the case? I'm assuming even more so now taking the under. Can we talk more about why you're still taking that stance?
Sure. Well, first of all, Rob, we can't take the over when the number's right around 100%. Right? The
Good point.
probability of rate cut isn't 150%.
A 98.1% probability too. When I saw that, that number stuck out to me. And the question, 98.1%, how do we get to such a high probability?
Yeah. So we had an interesting debate on this today. One of the things I love about running deep knowledge investing are the interactions I have with people on my board of advisors. They are phenomenally smart people. They're subject matter experts, and every idea, whether it's my idea or their idea, is subject to discussion and debate. And Mish and I had an interesting exchange on Twitter or X today. Mish's view, and by the way, take this seriously because he does know his stuff. He is a really good economist, great writer, great thinker. Um, his view is we are absolutely certain to get a 25 basis point rate cut in September. And if that's not right, it'll be a 50 basis point cut. So he's thinking 25 to 50 basis points. His reasoning on that is he thinks the economy has already entered a recession.
Mm.
The part, so I agree with part, I disagree with part. The part where I agree with Mish is where he's talking about the economy being in bad shape. And this is something we've talked about a lot here, Rob, this bifurcated economy. We have an economy with a ton of government stimulus and it's creating inflation, and that works for a limited number of people. But most of the country is not doing great financially right now. To that end, I agree with Mish. I think he's got this nailed. Um, but again, we've talked about a bifurcated economy, and part of what's happening is Congress is overspending by trillions of dollars. That is a massive amount of stimulus. The Treasury Department is monetizing it, which is a way of saying they're just, creating more debt. We're basically effectively creating more currency to cover all of this, and that's creating inflation. And so, what I think is that while Mish is right, that the economy for most people is not in great shape, the aggregate numbers, which include wasteful government spending, even if it destroys value, are going to look pretty good. If we get, a 2.5% GDP print and the CPI remains above 3%, it's a question. To me, it's not 100% clear that Powell will be ready to cut in September. So it's one of these kind of interesting things where Mish and I both agree on the facts. He's more dovish on the Fed's path than I am. I am more hawkish, meaning looking at higher rates than the market is right now. Although, again, in fairness, when the market is expecting, 100% probability of a rate cut, it's pretty easy to say take the under on that because you can't take the over. So, we'll see what happens in a couple of months. But, mea culpa here. I fully admit that that's at this point, that's no longer a bold prediction that I'm making.
You and Mish have any sort of friendly wager?
No, we don't do that. We just like to discuss and debate this stuff. Sometimes we get on the phone and talk it out. Sometimes we share articles. Today we were, tweeting at each other or posting at each other on X. But I'll tell you, I've read his work for a decade and a half, and he's somebody whose opinion I take seriously. I think he's really good at what he does. Again, it's mishtalk.com. Mish is Mish. I recommend everyone go check it out. I'm a huge fan of his work.
Great stuff. And we'll definitely keep in tune, obviously, as we come up to the September date. Gary, thing number 2, talking jobless claims, and jobless claims come in high. Thing number 2 for this week.
Well, Rob, this is the thing that actually would support Mish's point, right? We're talking about that bifurcated economy. So again, government spending, creating a lot of stimulus, keeping GDP high, keeping inflation high. But this is the side of it that Mish has nailed. So the initial jobless claims for the week ending July 13th went up to 243,000. That's up from 223,000 the prior week. And that increase of 20,000 claims exceeded the original estimate of 229,000 claims by 14,000. So is the economy falling apart here? No, these numbers aren't horrible, and there were some extraordinary factors. There was a Hurricane Beryl, which impacted Houston. That can lead to temporary changes. The end of a U.S. holiday period, we just had the July 4th holiday. That can lead to fluctuations. And again, Rob, how many times have we said the employment numbers are not accurate? They all get revised in the future. So, we don't have crystal clarity on this yet, but this data with higher than expected jobless claims does support Mish's point that the economy is not working for a lot of people.
So it seems like, Gary, the Fed needs to prioritize just from an objective standpoint, right? Are we going to continue to curb inflation or try to with higher rates? Or does this jobless claim post increasing put their objective to, hey, maybe we do need to cut rates? I'm assuming I know your answer, but where would you put your objective in terms of priority and why?
It's really interesting that you use the word priority because that's a key one, Rob. One of the things that is worth pointing out is that the Fed has a dual mandate. By the way, this is not set out in documents, it's just sort of accepted practice. If you look at what the Fed is officially required to do, it's not what they're doing. Their mandate is actually, their written mandate is actually stable prices, which is 0% inflation. Now, that's been thrown out. And the Fed has a dual mandate, or, custom is that they do. And so they're aiming for inflation of 2% or so. And they're trying to have maximum employment. Now, often those two things work against each other, right? If the economy is running hot, lots of people getting jobs, you'll have more inflation. The way that you get lower inflation is to cool off the economy, and that will lead to more job losses. And so the Fed they're going to be in a position where they're going to have to weigh these two mandates against each other. Inflation right now at 3%. And by the way, again, that's the CPI inflation. I think that's understated. I think most of us are experiencing cost increases in our lives of more than 3%. But that's running hot. But with employment, the employment statistics looking worse, more unemployment claims, that would lean more in Mish's direction, where, Powell doesn't necessarily want tons of people out of work. That said, the part of the CPI that's been running really hot is services. Part of that is a lot of wage growth. So, I think Powell's primary goal is to get inflation down, and higher unemployment would be a way to get wages more under control. I know that sounds horrible, to say that the Fed is trying to increase employment, trying to reduce wage growth. It sounds really terrible when we're talking about people's lives and people's homes. But unfortunately, these are the conversations that are being had. My solution, all of us, if you're disturbed by what I'm saying, first of all, don't blame me. I didn't make it this way. As far as I'm concerned, I'm still on team and the Fed. We do not need them. The market can set interest rates and we can get rid of all of this nonsense. And, if any of you are disturbed by the idea of a bunch of unelected bureaucrats who have never run a business deciding whether you have a job or not, I'm with you. I find it disturbing too.
Gary, moving to thing number 3, talking the Magnificent Seven. I know they've been propping up a lot of the stock market growth. Thing number 3, the Magnificent Seven's awful, terrible week.
Yeah, so the Magnificent Seven is a group of 7 mega cap tech stocks that have really led the market for the last 2.5 years. These stocks are the primary reason the market indexes are up. When you look at the great gains we've had in the S&P 500 and the NASDAQ over the last couple of years, it's been these 7 stocks. We're talking about Apple, Amazon, Google, Meta or Facebook, Microsoft, Nvidia, and Tesla. Obviously, Nvidia, their performance has been absolutely phenomenal. So what happened was last week, President Trump came out and said that the U.S. would not defend Taiwan if they were attacked by China. He further suggested that Taiwan should pay the U.S. for its defense. It is not our position right now to argue whether that's a good idea or a bad idea. Our role in that is simply to evaluate what happens, not to opine on whether this is good policy or bad policy. I'm sure a lot of the people listening to that will have strong opinions. We are going to limit our comments here to the economic impact. And so what happens is the best chips in the world are made in Taiwan. Taiwan Semiconductor is just at another level. There is no other company in the world that can make chips the way they do. And so fears that Taiwan Semiconductor may be facing an invasion took down really the entire market. We were looking at huge decreases in particular over the last week and a half. And some of this was reversed today. We saw some gains today. Today, Nvidia and Tesla were both up around 5%. But the last week and a half, Nvidia and Meta or Facebook were down more than 10%. Remember, these are like $3 billion companies. When a trillion, when a $3 trillion company is down more than 10%, you're talking about $400 billion of market loss. There were also pretty substantial losses in Amazon, in Tesla, really all of these companies. Even Apple was down, I think, about 4% for the last week and a half. They performed better than everybody else. It was just a horrible week for tech.
Gary, we're going to have some earning reports coming out over the next couple weeks, especially with several of these Magnificent Seven companies. Tends to provide some key indicators of market direction. Who are you keeping your eyes on most?
Well, the key driver in the Magnificent Seven has been Nvidia. They were briefly the largest company in the world by market cap. Their growth has been phenomenal. They make incredible GPUs, and they are really right now the best pure play on AI at the moment. What's really interesting is we haven't seen this shift into data center stocks. I don't know where people think these servers running the AI enabled chips are going to be, but we're also going to need a lot of energy infrastructure. It's one of the reasons we own uranium. Um, Another company that I think is two more, Rob, that I think are really interesting right now. One is Apple, because they've had declining unit sales. And that's a big deal. They're losing a lot of their Chinese market. Their products are expensive. I know that Apple fans love their product, but they're expensive. The competitors are catching up, and the last few quarters or so, they've had negative unit growth. They're selling fewer iPhones than they used to. That's going to be a problem for them, especially you're talking about a company with more than a $2 trillion market cap. It's hard to do that when you don't have growing revenue, when you don't have growing units. I also thought there was some interesting news out on Tesla today. Um, it's been announced that Elon Musk, he's come out publicly and supporting President Trump in his reelection efforts. And I think he agreed to spending something like $45 million a month to support
Correct.
him. Um, President Trump has come out and said that he wants to be agnostic on EVs, electric vehicles. He likes them, but wants Americans to have a choice, whether they have those or an internal combustion engine. And he said we should eliminate the subsidies. And Musk came out and he said, yeah, that's fine. Eliminate the subsidies. We're the market leader here. No sense in helping the competition. I thought that was really interesting, right? You figure with that news out, Musk would take it badly, but he's got a really good point. If you are the market leader, the last thing you want is something that levels the playing field. So I thought it was an interesting response by Elon Musk on that. So that's another stock that people should be watching.
Gary, I know, to follow up on Tesla, not a part of your portfolio, I believe, currently. Does this change your tune or make you take a second look at the company?
No, I understand why people own it. The people who own their cars love their cars. Um, and I certainly have, no problems with Elon Musk. Um, but I don't think the EVs are great for the environment. We had Lax Ganapathian from Unicus Research a while back. She's done some phenomenal work on how these cars aren't great for the environment. The the charging aspects of it aren't great. It's hard to find chargers. There aren't so many of them around. The other thing is the part of the car that has so much value is the battery pack. And those things don't have a forever life. You got to replace that battery pack in 7 or 8 years. That material is very difficult to recycle. It's difficult to dispose of. It creates an environmental problem, and you're looking at massive expenses down the road. It's one of the reasons, Rob, we're seeing a big decrease in the resale value of Teslas and other EVs. I think we mentioned this a few months ago. Hertz, they're selling tens of thousands of EVs. I just, the company trades at a massive valuation. I think their customers love their product, but I don't want to wade in at this valuation and this level of uncertainty.
Thing number four, Gary, we're moving to China. Thing number four is China throws liquidity at its banking sector.
All right. So, one of the things we've complained about here in the US with good reason is the ties between the large banks here and the government, right? This whole too big to fail idea, which Rob, I despise. But these banks got bailed out in 2008. People were understandably, reasonably angry about it. There was a mini bank bailout a year ago when we had a few medium, large size banks fail here in the US. And it's an issue. Now, China, they do the same thing, but they don't have the same issue with it. The Chinese banking system is over leveraged. They are hugely exposed to real estate. That market hasn't been good. And so the banks have had trouble. The People's Bank of China just injected over $100 billion into their banking system. It's the highest liquidity level since February 2024. And the reason they did that is because 40 Chinese banks pardon me, have collapsed recently. So, the banks some of them are going out of business. Some of them are facing bad loans. Some of them have declining profits. And so the People's Bank of China just threw a massive amount of liquidity into the system.
Lynn Alden, Gary, who I know work closely with, or you guys share a lot of same sentiments, trade work back and forth, and highly respected by you. She was on a recent show called Macro Voices and talked about China's housing market, consumer consumption, the weaknesses that are there, despite strong industrial production. One of the things she also pointed out was this kind of echoes Japan's disinflationary period. What does that mean? Is China on a similar path to what we're seeing in Japan as well?
That's a great question, Rob. And you're right. I have an enormous amount of respect for Lynn Alden. She's a first-class person and does incredible work. One area in particular where Lynn's work is really strong is she has a great handle on economic history. And so when you read her work, she will often compare things that are happening now to things that were happening 80 years ago or 100 years ago, or across different countries. And in this case, she did talk about how China's weaknesses in housing and consumer consumption, despite the fact that they have a lot of industrial production, that echoes Japan's disinflationary period. So that's something we've talked about a lot here. Japan had that issue for, I don't know, something like 30 years, maybe a little bit longer, where you had highly indebted private debt bubbles. And that led to a rotation from the private sector to the public sector. And, the government basically propped things up. Now, where Japan is at the moment, is they did so much of this that the government's taken on a massive amount of debt. And now the Japanese government is stuck in a situation where either they have to raise interest rates, which they can't afford to do because they've taken on so much debt, or they don't raise interest rates, which is a problem for them because the yen has been collapsing. Now, I actually don't know if Lynn has made a prediction on China's currency, on the yuan. But the thing that she's pointing out is this led to some problems in Japan. China may be heading in that direction. It'll be interesting to see what happens. Generally, when Lynn is doing these kinds of comparisons and predictions, it's a good idea to take it seriously.
Most definitely. Thing number 5, Gary, talking Treasury auctions. Thing number 5 on this week's version of the 5 things, Treasury auctions getting larger and also weaker.
Last week, Rob, we had Mark Rosano from C6 Capital on, and Mark was talking about this issue on the size of the Treasury markets. And he made some great points. There are also similar points to ones you and I have made on the show previously. Basically, what we've been saying is that government spending levels are unsustainable and worsening. So as the government takes on more and more debt, that means the Treasury auctions have to get larger, right? If you take on $100 billion of debt, you have to finance that, and you have to have $100 billion of auctions to finance your needs. But if you take on an extra $1 trillion of debt, well, now you're financing 10 times as much. So that is leading to larger Treasury auctions, but there's another part of this that's crucial. And when you take a look at the graph that Andrew's going to throw up here, you'll see at the end on the right side of the graph, there's a big increase in the auction sizes, particularly at the shorter durations, the 2-year, the 3-year. So what Treasury Secretary Yellen is doing is she's shortening the duration on our Treasury yield issuances. Sorry, our Treasury debt issuances. I said it wrong the first time. And what that means is she's issuing comparatively less 20 and 30-year bonds and doing more 2 and 3-year notes. And the reason that matters is because if you finance for a shorter term, you have to finance more frequently, right? So think about it. If Rob, let's say we had to finance $1 trillion and we do it through a 10-year note, right? So we'd finance it, and in 10 years, we'd have to refinance the $1 trillion. But what if you were doing it 1 year at a time? right? All of a sudden, year one, you do 100 billion. Actually, you have to every year, you'd have to refinance that $1 trillion. And so when Yellen goes to the shorter end of the yield issuances here, sorry, I keep saying that, the debt issuances here, that means the auction sizes by definition have to keep getting larger and larger. And so what we're seeing is it's the universal law of supply and demand. We have an increasing supply of treasuries and the demand isn't increasing with that. And so we're seeing at times higher yields, but we're also seeing larger tails. And what that means is the auctions aren't going as well as the government had hoped or expected.
Gary, the U.S. Treasury expected to reach record levels of issuance later this year. Again, kind of going back to Fed cuts, their argument trillions of dollars could be a sign of encouraging that cut. But you're saying it's crucial to remember that those yields are determined by the market. Tell us more about that.
So we had a really interesting discussion again on Twitter or X. I was writing about this and somebody chimed in that if the Fed would just cut rates, we could cut our interest expense. And my answer is sort of, right? So, yes, when you cut the Fed funds rate, in general, the rest of the yield curve comes down as well. So, if you cut the Fed funds rate, you can expect the 2 year and the 10 year and the 20 year, 30 year, those yields tend to come down. However, there are two key things to remember. One is the Federal Reserve only has control of the Fed funds rate, that's the overnight rate between banks. Every other duration, whether it's 1 month all the way out to 30 years, is set by the market. The other thing is when you lower rates, you end up with an increase in inflation. So if you end up with an increase in inflation and you go further out the yield curve, right, to your 5 year, your 10 year, your 20 or 30 year, the expectation will be that rates will have to be higher then. And so there's no guarantee that by lowering the Fed funds rate, if the market perceives that to be something that would create future inflation, you can end up with the outer end of the yield curve going up on a Fed rate decrease. Now, do I think that's going to happen on day one? No, but if you're running, a $35 trillion bond issuance portfolio like the Treasury is, you really need to be planning for more than day one. This is the kind of thing that could lead to disaster down the road.
Thing number 6, Gary, we're actually doing a bonus point this week. We're talking tax receipts, government spending, and that's exactly it. Thing number 6, bonus point this week, tax receipts versus government spending.
So, Rob, you remember as part of the 5 things a couple of weeks ago, we talked about how Fed Chair Jerome Powell went in front of Congress and flat out called their overspending as unsustainable. The reason I thought that was interesting is Powell has generally tried to avoid making a lot of comments on congressional spending. And he's had to exercise a lot of discipline to do so. He's been increasing interest rates to try to get inflation down. Congress has been spending a lot, stimulus spending, which ends up creating more inflation. So I thought it was really interesting that Powell went in front of Congress and just flat out told them, listen, guys, you can't keep doing this. It's not going to work. And, when I wrote that, there were a couple of people on Twitter or on X who came out and said, this is, it's tax cuts. And, it's not a spending problem. It's tax receipts, which they incorrectly call revenue. Government tax receipts are tax receipts. That's not revenue. Revenue is a voluntary exchange between two parties that decide to exchange goods, services, money, whatever it is. Taxes are not revenue. But at any rate, what some of these people said to me is, no, you're wrong. We've had all these tax cuts and government, they say revenue, I say tax receipts are down. And, therefore, if the government would just tax rich people more, we wouldn't have a problem. There's no issue with the spending level. So we took a look at the chart, right? We had Andrew put together the chart. And what we saw is that, let me see if I just go back roughly a decade or so, tax receipts were around $3 trillion. They are now in excess of $5 trillion. That is massive growth. But in the same time period, government outlays have gone from $4 trillion. They peaked around $9 trillion during COVID, and right now are sitting somewhere just under $7 trillion. So we've had a massive increase in tax collections and an even bigger increase in government spending. We're at the point where government spending is pushing out the private market economy. In my opinion, this is not a revenue issue, and we shouldn't be using that word. It's not a tax collection issue. The real issue is our government is spending too much, and they are going to continue to do so until the dollar has no value.
And the argument that you're receiving back, Gary, is okay, we tax the concept around taxing the rich. That's a way to pay for the benefits of the poor. Your argument in response is that yes, but the problem is the government spending continues. The government spending is focused on consumption, not investment. And no matter what, regardless of whether or not you're creating more tax collection, it's still creating inflation due to this government spending.
So, Rob, that's the key thing. When people have these conversations, they say, okay, well, we should tax the rich more and spend more, and that'll be good for poor people. And they think these policies will help poor people. And the part that I think they're wrong about, the part that I think maybe they're missing something, is that you're entirely right. First of all, this government spending, it's not an investment. It is simply pulling consumption forward. We're taking on debt for this. The more important thing is all of that government spending it's exactly what you said. It leads to inflation. So if you are a hedge fund manager and you own assets like stocks, real estate, gold, Bitcoin, if you own hard assets or stocks that will benefit from inflation, you can do great in that situation. If you own your own home, right? As the dollar goes down in value, the dollar price of your home will go up, but the value of your mortgage payment every month goes down. Inflation works well for a limited number of wealthy people. It is crushing the poor people. So while I applaud their good-hearted effort to try to help poor people, I'm going to suggest that their plan to do so, even though they have good intentions, will actually make things worse. That the best thing we can do for poor people is reduce government spending, get inflation under control, help these people get jobs, and put them in a position where they have more control over their lives and where they can save in dollars and not see the value of those dollars go down. Every month we're in a situation, Rob, where just the grocery bill or the electric bill, it's just crushing families, right? And at this point, we're at the point where it's not just hurting, poor people, it's hurting the middle class as well. Inflation is a horrible, horrible tax on poor people. And so if these are the people you want to help, good for you. It's great to want to help the less fortunate, but from an economic point of view, there's a better way to do it. And that's what I'm suggesting. And when you take a look at this graph, it should be pretty obvious, and also worth pointing out, as government spending has grown, we still have more and more people living from paycheck to paycheck. It's not working.
And Gary, I know you've mentioned in the past too, this isn't a Democrat issue. This isn't a Republican issue because both sides are frivolous spenders. Let's say we did have a scenario in a makeup world, right, where you did have someone that got it and understood what we were talking about in terms of curbing government spending. How quickly can something like this actually get to a point where we are curbing inflation and things are getting back to some sort of normalcy? Because for me, it just seems like the hole is being dug deeper and deeper and deeper and deeper. And it's almost as if it's a lost cause in terms of even being able to get out of that hole.
Yeah, there's a really good open question right now. Has it gone too far? Is it possible to get this under control? And it may be possible to get our $35 trillion of on-balance sheet debt under control. But what we do with our more than $200 trillion of off-balance sheet liabilities, I have no idea. There's no way, there's no level of taxation on wealthy people. You could confiscate every dollar every billionaire on the planet has. It doesn't add up to $200 trillion. And those are programs like Social Security, Medicare, Medicaid, Obamacare. Those programs are really expensive and we have massive liabilities coming up. I don't know that those can be addressed without really hurting people's expectations for what they're going to receive. But in terms of an ability to turn things around, we have two great examples recently. The new president in El Salvador, he's gotten their crime rate down. He's gotten their inflation rate down. Their economic growth is better. Things changed pretty quickly there. And then Milei in Argentina. Wow. I mean, he slashed government spending, took them from a massive deficit to a surplus in something like 9 weeks, I think. It was like 2 or 3 months. Their inflation rate's coming down. He's got more work to do. But the fact is, if you have the right person in office and people willing to follow along with that plan, you can get some really good impact quickly. Now, Rob, you're totally right. This is a nonpartisan issue. I'm not taking sides. If you're listening to this, you can be team red, cool. You can be team blue, good for you. I don't care. Whoever you are, you're welcome here. The only thing I'm going to tell everyone is that we cannot vote our way out of this. Right now, the smart money is betting that President Trump retakes office. He is a big spender. He's not going to cut spending. And even if he has a Republican Congress, he's still not going to cut spending. And a Republican Congress is not going to cut spending. We don't know yet who is going to be leading the Democratic ticket. The smart money today is betting on Kamala Harris, but we'll find out more in the next couple of weeks when the Democrats have their convention. The only thing I can tell you is whoever they pick is not going to cut spending. So we're not in a position right now to vote our way out of this. We don't have a Milei or a Bukele, or a Rand Paul in position. Somebody who's a real economic pragmatist who will cut spending. So whatever happens, we're going to have more spending. And if you're worried about inflation, if you're worried about the economic future of this country, I can assure you that there's no one you can vote for this November that will fix that problem. And I'm sorry to be laughing about that. It's not a pleasant thing to say. It's not a pleasant thing to think about. But you're totally right. This is not a partisan issue. Feel free to vote for whoever you want to, but our government spending is not going to come down.
One thing you can do is get a premium subscription to DKI, access the current recommendations portfolio, helping you hedge against inflation with different positions that have set our followers, subscribers up for success in any type of market. With that being said, this wraps up this week's version of the 5 things. As always, please head to our website, deepknowledgeinvesting.com. Sign up for a free subscription where you will get information on the 5 things, as well as notifications on certain material that Gary's putting out there. With that being said, we do have a premium level subscription that allows us to continue to produce this great content. That allows subscribers to access material before anyone else, full transparency on current recommendations and portfolio, and a lot of other benefits in terms of special guest webinars and whatnot over the course of time. Gary, thank you so much. As always, any closing thoughts from you?
Thanks, Rob. Always fun filming these with you. Great to spend this time with you. For everyone else who spent this time with us today, thank you. We really appreciate it. We know your time is valuable. And I really appreciate what Rob was saying. We started to prepare our subscribers for inflation in November of 21. And at the time, we were buying gold, Bitcoin, oil, energy, uranium. Those are all things that have done really well. And so, one of our key messages is a lot of the things that we talk about are not pleasant. A lot of our views on the economy, what's happening with people, it's scary. It's not a rosy outlook. But my key message to everyone is don't be upset about it, right? There are ways to protect your portfolio, your home, your net worth from these things. And if you handle it right, there are ways to make money from all of these issues. And if you're confused about that or want some help, reach out, like Rob said. I'm also reachable at ir@deepknowledgeinvesting.com. Feel free to reach out. We've helped a lot of people with these issues. We are not pessimistic on a daily basis. We feel like we can always find ways to help people make money. So reach out if you want some help.